Hey guys, what is going on? Welcome back to the portfolio. Again, I want to thank everyone out there for supporting the channel. If you guys do like the content, if you guys do like the video series, feel free to like, share, and subscribe. And if you are a subscriber, make sure to hit that bell button to get alerts and updates on all new content posted on the channel. For today's video, I want to respond to a number of viewers on the channel wondering what happens to a stock's price on the ex-dividend date. A lot of investors that follow the dividend capture series of videos always remark that the price of the stock always seems to drop on the ex-dividend date, and there is a reason for that. I want to take Ford as an example here. Ford Motor Company. If we take a look at the performance over the last 1 day of trading, you can see on Friday it was down 1.03%, 0.11. After hours did rebound a little bit there, 0.04. And then over the last week here, you can see that very large drop off here on the ex-dividend date on July 20th, dropping from about 1080 or so down to 1050. If we take a look at the 1 day of trading to get a little bit better resolution with that, you can see it started trading here right at 1072 or so. Then right after trading dropped down to 1060. So about a 12-cent drop or so. The dividend was 15 cents. So on the ex-dividend date, the stock will always drop by the price of that dividend. For this particular stock, it will always drop by at least 15 cents per share because that was the dividend that was given out. That's done automatically by the stock exchange. It always happens. There is some trading around that as well. So you can see here in pre-market trading, the stock was going up and down, as well as after trading starts, the stock will start moving on its own as well. So some of those changes are masked somewhat because of the stock trading around the ex-dividend date, but on the ex-dividend date, the stock will always drop by the price of the dividend. So part of the dividend capture strategy is that after the stock drops on the ex-dividend date, because it represents a proportion of the share's profits, you would expect that the company, if it's still a profitable company, will start making back that profit over the next couple weeks, couple months. Most companies have a quarterly dividend, so by the next dividend payment, that stock usually recovers if it's only based on that alone. Yes, there are other market factors that are decreasing and raising the stock price, but the dividend will recover if it's a profitable company over that time span, and a lot of these stocks will recover within 1 or 2 weeks. So the whole idea is that you jump in before the ex-dividend date, somewhere in here, for example, with this stock here up on screen, Ford, you hold into the ex-dividend date, and then you can sell on or after the ex-dividend date. You still qualify for the dividend, and then hopefully as the stock rebounds after the ex-dividend date, you can sell the stock for the same price you bought it for, or you can sell it for more, which makes it a positive swing trade as well. So a dividend capture, a swing trade. But again, the stock will always drop by the price or the amount of the dividend on the ex-dividend date. It does not matter what the stock is or how much the dividend is. I just put out a video talking about special dividends and why I don't necessarily like special dividends. For this particular stock, again, the dividend dropped 15 cents off the stock price. Again, the dividend was 15 cents. The stock market exchange will always take that out of the price of the stock automatically on the ex-dividend date. So 15 cents, relatively small compared to the overall stock price of 10.60. And this is a high dividend yielding stock as well, as you can see in the middle here. 4.8 on the last dividend payment. This last dividend payment was a little bit over 5.6%. So even a very large dividend payment is only a few cents versus the price of a stock. But if it's a large special dividend like the dividend with Dr. Pepper at $103.75, that company is never going to make back that profit in a year or 2 years. That's a very large dividend payment, so you can never expect to jump into that particular stock, capture the dividend, and then get out of that stock in a positive swing trade. That's simply not going to happen. But with a stock like this, that's simply, again, giving the investor back a proportion of its share price in the form of a dividend. But that share price dividend is representing what the company has made during that particular interval, whether it's a monthly stock or a quarterly stock every 3 months. These stocks will rebound if there is no other movement going on in the market. You can see here with Ford, however, it's down 8.91% over the past 1 month. This is simply market trading. It has nothing to do with the dividend payment. But again, on the ex-dividend date, a stock will always drop by the amount of the dividend. So don't be alarmed by that. That is very normal. So when you do jump into a stock, it does trend down here. Over the next few weeks, maybe a month or two, the stock should get back up to the price you bought it for, and then you can exit your position in a positive swing trade. So very important to know, and that is very typical of this type of strategy. You can't simply jump in the day before and then sell on that next day and expect a positive swing trade every time. That's actually quite infrequent. You have to hold the stock typically for a few days, few weeks, maybe even a few months before that stock trends back up to exit the position in a positive swing trade for the dividend capture swing trade. Another thing to take into consideration as well with options trading, make sure you know the ex-dividend date when you jump into a position. I had $11 put on Ford for the 20th. Unfortunately, the 20th was also the ex-dividend date. So I would have had a positive trade here. I had $33 for a trade. So really, I could have bought this stock at $10.70 or so, made a profit. Again, I would have to buy the stock at $11, but if the stock's trading at $10.30 with a dividend payment, balances that out. However, as the stock dropped here on the ex-dividend date, it was a negative trade overall. I did get some premium for making that trade, but I had to buy the stock at $11, 40 cents per share, 100 shares, $40 loss on that trade. Did not make up that dividend payment or that premium payment of $33. So just keep that in mind as well when you guys do options trading. Always make sure that you're not doing a trade when there is an ex-dividend date coming up. So just wanted to jump into the portfolio to go over this. This has been a quite frequent topic on the channel, or at least comment on the channel. Why does the stock always drop on the ex-dividend date? And that is because it's an automatic drop by the stock exchange. It'll happen every single time by the exact amount of the dividend at least, but there is still normal trading going on, so you might not always see it drop by that exact number because of the buying and selling activity of the stock in general. So just wanted to make sure that you guys knew that the stock always drops on the ex-dividend date. Again, if you guys have any questions about the dividend capture swing trade type of strategy, let me know. I try to do at least one of these videos per week detailing stocks that I'm contemplating on jumping into for this strategy. So, and if you guys have any questions on this video, other videos, please let me know in the comment threads down below. And I'll do my best to get back to you guys as quickly as I can. So kind of with that, I'll end the video, and we'll see you guys next time.